Hey, what's up, guys? Hope you're doing well. I want to talk to you about quarter three, what happened and why. What do I anticipate looking ahead? So, as a reminder, before I get into it, this video is not financial advice. I am your financial advisor, but this video is for your education and your information. The reason for that is because I am sending it to everyone at once. Anytime I'm giving you financial advice, it is to you individually in a conversation, or particularly in the way that I'm managing your portfolio, your individual allocation that is specific to you. This video, again, it's supplementary, it's helpful, hopefully it's a little bit entertaining, a little bit educational, and I'll just dive right into it because quarter two, last quarter I talked about how, hey, this probably is not a new bona fide bull market. We had a really strong quarter two, year to date, had a really strong performance thus far, and we did have some fundamental progress, particularly in the AI space, some of the big tech names, seeing some development, some company development to support some of the growth that was happening. But my overall consensus was, hey, this is probably more of a melt up type of situation. If you remember that, that's about people that are betting against the market being forced to cover their tail, close out some of their short positions before this thing got too out of hand. So in quarter three, what we saw is that speculation was the case. We gave back some of those gains in quarter three. We're still up overall year to date. We're feeling good. But hey, hopefully I was able to temper your expectations a little bit in quarter two to not think we're just going to keep going up at the same rate. But that, hey, we're probably going to give some of this back. A melt up scenario is not 100% fundamentally supported. It can't continue forever. That said, we did see some new economic developments in quarter three that I want to talk about, and I did make some structural positioning in your portfolios in quarter three that I want to talk about, at least on a broad level, a general sense. Again, if you want to talk about specifically your portfolio, exact percentages and numbers, feel free to reach out to me. So I want to dive into some of those things from quarter three and also talk about my outlook looking forward. And so let's dive into the big picture, but I also want to talk about a couple specific companies because the big picture economy is going to do what it does. It's important that we talk about it, but as time passes, each company, they have leadership teams with objectives, they have missions, they're giving reports on, status updates, progress, financials. So it's not just time passing. You're not just waiting for the big picture economy to do something, and that's the only way that you make or lose money. Companies are out there working, and some of them are working well, and at a company level have seen really important developments in quarter three that have me very, very, very excited. So I want to talk about those. But let's zoom out to the big picture economy for a minute because it is quite the juxtaposition. It's the bull, the bear, it's the upside, the downside. It's a very it's a high standard deviation of like the possibilities and probable outcomes in the coming 12 months. On the negative side, you see cracks widening for sure. We had just a couple days ago, we got our August report for credit card debt levels in America. And in July, they grew by the largest amount ever, and to on a monthly basis, they grew faster in a month than they had ever grown before, and they were already at all-time highs. And then in August, they grew like even faster than in July by a significant margin. I think July was around 10.8 billion and August was like 14.5 billion, something around there. So credit card debt levels are at an all-time high and they're growing at an all-time record pace. That is a crazy a crazy situation. Normally when things grow fast, it's because they start from a small base. And so it is getting out of hand for sure. And we don't even know yet about September, but I would not be surprised if it's growing even more. Simultaneously, the cost of debt is growing, right? Inflation, interest rates rising. We just had a jobs report come out yesterday, Friday, October 6th, I believe, um, that indicates that interest rates will probably continue to rise. We're not seeing everything that Jerome Powell wants to see yet. So he's going to keep being hawkish, which means the cost of debt is going to keep going up. And the amount of debt that people are paying on is continuing to go up. Simultaneously, we have interest repayments, student loan repayments that are hitting or just started hitting, I believe, in September, maybe in August. And so that's money that people haven't been doing anything with, or that's an expense in their monthly budget that they haven't been hit with for 2 years now, 3 years now. And so that's significant, that on top of paying more credit card interest than ever and being more behind than ever, now there's also student loan repayment that's hitting as well. And so the consumer level, I mean, people are feeling it. You are probably feeling it. You might not be feeling it as much as other people, but the everyday working person at a medium tier or lower tier job is feeling the pain. And statistically, what we see is that people aren't just all of a sudden, picking up a second, third, fourth job, like eating rice and beans for their meals. Like, no, they're continuing the same lifestyle that they're accustomed to already, and just paying for it with debt that they can't afford. And it's growing fast, which is unsustainable. That's a key for us looking at the economy is, hey, this is unsustainable. That's code for it's going to break down at some point. So cracks are widening. I could talk more about the widening of cracks, but hopefully you already sense this intuitively. I guess one other thing I could mention is that the market is more shorted now than it has ever been. So that means a lot of people are betting against the market. A lot of people are bearish, waiting for a recession. But on the other hand, we do see some companies that are fundamentally progressing along their corporate objectives, and we see some AI spending. We see that that technology is developing, right? That technology itself does not care what the economy is doing. Like ChatGPT, a language learning model is not going to succeed or fail based on what Jerome Powell does, right? And so you're seeing some company progress, and more importantly, there is still so much liquidity in the market. And that liquidity is coming from hedge funds, from institutions, from the ultra wealthy, from the government. It's not you and me and normal people that just have all these piles and piles of cash, but it's all this money that got printed basically in 2020 and 2021 that is still being flushed through, and it's not done yet, which is why interest rates are needing to grow, which is it's a significant causal factor to the situation that we're in. It's not the only one, but that's the gist of what Jerome Powell is trying to solve. Is we got to get all this excess money out of the market, because this funny money can create negative situations. It can create outcomes that are, again, unsustainable. So the Fed's hope is that they can achieve a quote-unquote soft landing. They can just slowly get this excess liquidity out of the market, get companies back to normal levels, get shorting back to normal levels, get debt back to normal levels, etc. But what's happened so far is that the everyday household is getting pinched so significantly without the same level of pain being felt by the upper echelon pockets that actually hold, the majority of this liquidity. The majority of wealth is held by the upper, 5%, upper 1%, aka like the businesses themselves, the company valuations, right? That's where a lot of this money is, and in the government itself. Until they feel the pain, there won't be necessarily a soft landing, But if the households completely break down, in other words, defaults start, climbing at a record level, then the recession is going to come sooner rather than later in that scenario, because ultimately the recession comes whenever everyone feels super afraid that the recession is coming. And so far, the media, the government, etc., has done a great job at preventing mass chaos, despite so many, big red flags, big warning signs, some major bankruptcies that have happened, from just huge companies, Credit Suisse and a lot of Chinese companies, Evergrande, huge real estate developer in China, and simultaneously, even well, I'll pause on the bankruptcies, but so a lot of pain is being felt, but the level of fear is not necessarily there. It's not like, oh no, a lot of people are just going to work, they're feeling the pain, their debt's rising, they don't know how this is going to fix itself, but just keep doing things one day at a time, hope it gets better. But you're not seeing mass layoffs, right? You're not seeing companies themselves saying, uh-oh, like the show's over, we need to save ourselves. When mass layoffs happen, it basically company valuations go down, which bleeds out liquidity a lot faster. And then also people, if people lose their jobs, defaults are going to go up a lot faster, from foreclosures to credit card debt or student loan debt, whatever, just repayments failing. And then it's unavoidable in terms of the fear of a recession leading to a flushing out of excess liquidity. That sounded so like doomsday and terrible. But keep tracking with me. If you're watching this far in the video, then let's just go on this ride together. But that's my big picture assessment of where the economy is at. Is cracks are widening. There's a lot of red flags. But on the other hand, there is still so much money. And when there's that much money out there in the world, held by big pockets, they have to put some of it somewhere. They're not just going to put all of it in their mattress, right? They have to own some real estate, own some businesses, own some currencies, right? What else are you going to do with it? You have to buy stuff or buy companies. And so that is a bullish support for the overall economy. Simultaneously, the tech development, the AI development, the progress of individual companies, it is a support for the overall economy. Even though the economy is suffering, if super valuable companies are making super impressive progress, that is going to keep other ships afloat for longer. And lastly, like I mentioned, this market is the most shorted market ever. And in a weird way, that also kind of supports this this sideways trading. It's not a bullish indicator. It's bearish that so many people are bearish, right? You would rather people be super enthusiastic, like everyone needs to buy stocks, like this is the best time ever, and everyone FOMOing into the market. That would be more bullish for the stock market. But so much short selling can create these melt up scenarios, these short squeeze scenarios. One of the greatest risks to the downside narrative is that it takes longer than what the bears want, and therefore they bleed out enough in terms of making interest payments on their shorts that they have to go ahead and close their shorts, which forces another melt up and another leg up in this squeeze-like scenario. So there's a lot going on, right? Hopefully you're tracking with me so far. But in the big picture economy, it's influenced the way that I'm managing your portfolio, because there's really three outcomes. And the biggest question is the time horizon. You just don't know when exactly anything's going to happen. But this middle option is that the Fed succeeds in creating a soft landing. And what that would mean is we continue to, kind of go up some and then kind of go down some, like you've experienced for the better part of your portfolio. All-time highs in the stock market happened December of 2021. So we are almost 2 years out from that threshold, which is crazy when you think about the valuation of so many other assets, the valuation of so many goods that you need to purchase, inflation. Like, you would think, surely the value of a company, if everything costs so much more now than it did then that would go up. But in fact, they have failed to grow in valuation on an overall market level basis for 2 years now. So perhaps we continue this soft landing, but it is looking less and less likely to me that the Fed will succeed in a soft landing. In the other two options are basically a melt up, where basically big tech and the development and the economies that are created, the GDP that is created through technological breakthroughs, just almost like cancels out the recession and forces shorts to close. And there are so many shorts out there that it would be like a great payday, most likely, for all of us in this scenario. And the companies that you own, we're going to outperform, like you saw in quarter two. I can't guarantee that we're going to outperform, of course, but my anticipation is that our portfolios would do great if basically technological breakthrough enters us into a new stage of business and the marketplace and the global economy, the global domestic product, what companies are able to achieve. Basically, tech gets us there. And shorts, as a result, almost like double the impact of the technological breakthrough as it relates to prices over the next, say, 12 to 24 months. So that's kind of the bull thesis. And liquidity, money rushes in. There's still so much money out there, etc. The other scenario is a meltdown. A meltdown is not an investment term. It's just the actual normal phrase. It's a breakdown, a bottoming. The bottom falls out of the market. So far in the past 2 years, we haven't really crashed. We've just been kind of range bound, as some investors would say. And so if some of these tensions, some of these cracks widening, if something breaks, whether it's the value of USD going down through China working on using the yuan as the global reserve for at least a certain portion of the world, whether it's just bankruptcies in companies or mass layoffs because companies start feeling the pain. Households are all feeling the pain, and companies can keep going as long as they still have buyers for their products, right? But if buying power goes down, because so far, again, I'm hopefully you're tracking with me. I'm a little bit windy, right? But so far, people haven't changed their lifestyle, right? They've just been increasing their debt. So companies can still sell their services. They can still sell their products. People are still going to buy them because they're still spending based on their appetite, based on their desire to have whatever it is they're spending on. But we know that households cannot keep it up forever. Households overall, statistically, are bleeding. And at some point, they will max out every card. At some point, they won't be able to buy as much. Simultaneously, the technological breakthrough could lead to some jobs being laid off as well, if they're kind of mundane tasks that all of a sudden now a robot can do. But that's a little bit of a rabbit trail. But households can't keep up the buying forever. If and when they can't, companies are going to feel it. It's going to hit their revenue, which is going to hit their cost structure. If companies need to start saving costs to maintain profitability, you're going to see more layoffs. The more layoffs that happen, then you're not going to see strong jobs reports anymore. And that would be the sign, probably, that Jerome Powell finally wants to see that, okay, it's going good. But at that point, it might create such a ripple effect that is so severe that it's like, yeah, we finally saw a bad jobs report, but what you don't know is we're about to see another 16 months of bad jobs reports, And I'm not saying we will, but it's in this scenario, it's likely that if everyone's increasing in debt together and everyone's feeling the pain together, then companies are going to start feeling the pain together. They're going to start laying off together, which is going to become this vicious cycle that increases the pain that people are feeling, increases the debt that they need to take on, lowers their ability to repay the debt, increases the level of bankruptcies and defaults. So this is the breakdown. This is the bottom falling out. This is the scenario where there's a lot of fear, a crash that happens in the market. In that scenario, I also think ultimately it will be a payday for us, not just in the 10-year time horizon where, we can buy at this bottom price and then grow. But actually in the midst of a severe recession, I think our portfolio will do well. I've mentioned this in videos, probably in every video, but I'll kind of explain a little bit more and dive into that today. So economy-wise, those are the scenarios that are happening, or those are the updates of what's happening, and then I just explained the scenarios of how that could play out. Now, when exactly those scenarios play out is anyone's guess, really. Again, the government's goal, corporate America's goal is to delay either extreme for as long as possible. But the question is, how long can they really delay it if simultaneously we're seeing cracks widening and simultaneously we're seeing tech develop? We're seeing technological breakthrough. And there is still so much money that's betting on the crash and betting on investing in these companies, right? So your portfolio, what am I doing? What am I anticipating in the coming quarters? Quarter 4, I think, will be more encouraging than discouraging, but probably kind of sideways-ish. And then maybe quarter 1 or maybe quarter 2, we see one of these scenarios begin to play out. And let me just explain kind of how I'm structuring your portfolio to take advantage of either. Why do I feel like either scenario becomes a payday for us? The scenario that is not really a payday is sideways. And that's fine. It also won't be that painful. It'll be a little painful, but not that painful. And all we know is it's a delay of either an upside or a downside move. The stock market, I would be shocked if for 5 years it's just, it's somewhere between 45,000 to 35,000 a share for S&P 500. I would be so shocked if that was the case. I think in less than 5 years, we will see a breakout or a breakdown, and either way, I think it will be a payday. Now that takes me to what am I doing in your portfolio? Because what I did in quarter 3 is I just increased the concentration on my highest conviction names. My hope is that in quarter 4, I can send you a specific video, maybe like 2 to 4 of them over the span of quarter 4 to dive deeper into each of these highest conviction names. But on the bull side, the breakout side, the technological breakthrough that almost leapfrogs and usurps the recessionary fears, my highest conviction name is Tesla. Now, Tesla is a highest conviction name because of the ethical/moral side of it, as well as the financial side of it. And again, I'm going to make another video in this quarter to explain more. But the short of it is they are dominating, and they have created an electric vehicle market that is unlike what any ICE automaker or internal combustion engine automaker could have foreseen. And they had about a 10-year head start related to every technological process needed to grow sustainably and quickly an electric vehicle fleet. So they didn't create the electric vehicle, but I would say that they did create what we now know as the modern day EV market, and it is on an exponential growth curve. And Tesla is by far doing it more profitably than any other automaker, especially when you look at EV sales specifically. Now, just cars, period, if you just put them all on the same level, Tesla produces each vehicle more profitably than any other automaker in the world already. But then if you look at EVs, only electric vehicles, Tesla's profits are just astronomically ahead of any of the competition. Almost every single company actually has failed to produce a single electric vehicle profitably. They take losses on their EV sales, but they still make them, hoping to reach scale, hoping to be a brand that makes it into the next generation of our world economy. But they're funding those losses with their internal combustion engine vehicle sales, which have been on a significant downtrend for a couple years. And in a recession, the auto industry globally is the worst performing industry of any company, of any industry. Now, you could say, why would you invest in Tesla? Okay, well, I will say I did put it in the breakout scenario, but if you go to the breakdown scenario, it's still a very high conviction name because it will be addition by subtraction. Tesla is growing so fast, and they are just beginning. They have so much still to do. They have many models still to come out. Basically, what a severe recession would do would wipe out so much of Tesla's competition, who are already suffering and are already many of them losing money, and almost all of them losing money in the EV space. And when you talk about 10 years from now, is preserving the world's finite resources going to be more or less important to the human population? It is going to be more. The EV market will continue to grow, and Tesla is in so many ways, again, I'll talk about in another video, in my opinion, just cementing themselves as the world leader, kind of the Apple of the smartphone. And that said, the most important thing from a bullish perspective on Tesla isn't even any of that. It's their progress in artificial intelligence. They have the third largest compute power of any company in the world, and they are solving for vision-based artificial intelligence, or artificial general intelligence, AGI. So ChatGPT is an example of a language-based learning model that was being built, and seemingly overnight hits this crazy breakthrough where now it is incredibly useful for so many purposes. And we're beginning to see that breakout with Tesla's vision-based AI, an intelligence that can look at videos and then learn from them, look at images. So you're seeing this in their their humanoid robot that's able to do things in just a couple months of video training that no one else thought was going to be possible. But more importantly, you're seeing it in their autonomous driving capabilities. In Q3, Elon Musk posted a video or a live stream to his Twitter profile or his X profile of him doing a 20 to 30 minute drive on his autonomous platform. It was by and large a very successful drive, but the main thing that he kept reiterating is, hey, none of this is code. We haven't told this car anything about what it is supposed to do. We have just shown it videos of what cars that are good drivers do, and here's what it's doing. And it was breathtaking. It was amazing. And most importantly, it means Tesla is getting close to solving for autonomous driving. Now you might say, like, oh, that's so pie in the sky. Here's the thing, guys. Cruise and Waymo, though they don't use it with the same technology, so it's not nearly as scalable, they have already solved for autonomous driving, not just in a technological capacity, but they've also already been approved to operate driverless vehicles in San Francisco. So, and I think Waymo and maybe Phoenix as well. That means that they're able to use these cars that don't have a driver to do things like taxi, to do things like, obviously food delivery isn't there yet, but the implications of transport that doesn't require a human, the money to be made there is almost unfathomable compared to the cost structure of, say, an Uber. So Tesla is seemingly getting very close, and Elon Musk has said many times, like he's becoming increasingly bullish that it is very close to getting to that level. And Tesla has millions, already over 5 million vehicles in the fleet, in the world driving. So Waymo or Cruise, they can build a couple dozen, right? and they can be limited to these specific streets, that they're allowed to drive on. But when Tesla solves for it, it's going to be an AI-based, a vision-based solution that is so scalable that it will take the market by storm. I would be very surprised, very, very surprised if Tesla is not ultimately the most valuable company in the world. I don't know when exactly that would happen, because it would take a couple of years of seeing those profits hit the bottom line. But on a technological capacity level, the total addressable market that they are in the lead in and looking to solve is incalculable. Like, it is actually incalculable, especially if you talk about the humanoid robot as well. So bullish side, so increasing concentration there, and maybe I'll share more soon. On the bearish side, increasing concentration in a couple names, but particularly GameStop. Now that might strike a chord with you. You might say, why in the world would you put your money in such a company? You might remember in 2021, January 2021, this meme stock explosion in GameStop and other companies like AMC, and it became it became a meme of, look how dumb millennials are, just throwing their money into obviously failing, bankrupt companies. Now, I'm going to try to keep this video short. I'm trying to give you a Q3 summary, and I'll share another video this quarter about GameStop specifically and the nature of the problem. But this is my highest conviction name in really also a bullish or bearish scenario, but even more so in a bearish scenario. And that is because it remains one of the most shorted companies in the world. And if you don't know the implications of a severe recession on a very heavily shorted company, go ahead and look up the price history of Volkswagen, who in 2008 became the most valuable company in the world. It was like down here, and then it was like boom, like in a day, in an instant, up thousands of percent, because all these shorts were forced to sell, and the company was owned by a heavy concentration through people that knew that this short sale was happening, and therefore they don't have to sell when it just goes up 100%. They might wait till it goes up 1,000%. GameStop is still very, very shorted. It is, in my opinion and my speculation and my best guess, very even more shorted now than it was back in January 2021. Now, the shorting is not really the main or the only reason why you would invest in this company. I'll say that right now, but certainly in an upside scenario, it would be astronomical potentially what could happen to GameStop that is much more shorted than Volkswagen ever was, and is more concentrated in its ownership in a lot of ways. For example, 25% of the company is owned by individual household like retail buyers, like in their name. So This doesn't include any of your holdings. Like, it is, because those are held in street name. Anything that anyone owns in a brokerage, technically the broker owns it, and they give you, credit or an IOU for one share. I'm getting a little bit too into the weeds here, but 25% of people have direct registered their shares in a way that it is their name, not any type of brokerage. And that has never ever happened before, even close with any company. I don't think any company surpassed 5% before. So the support level is huge on a household, on an individual investor level, and in an insider level. You're seeing significant insider buying on a quarterly basis. I mean, more and more and more. The owners, the operators, the board of directors in GameStop are buying in. And that is because the company fundamentally is transforming significantly. I have been following this company very closely, and their Q2 earnings came out in Q3, and and I was just blown away by the progress that they've made. They have been changing their cost structure by hundreds of millions of dollars, to the point where probably in Q3, when they report their Q3 earnings, or when they report their Q4 earnings, which would happen probably in March, they will actually report a full year profit for their company. That's what looks probable based on their trajectory, which is crazy. It's hard to explain how improbable that is, that GameStop has gone from a dying brick and mortar company to it's actually a profitable company and growing in profit. Simultaneously, it has a negative beta, which means that it's inversely correlated to the market. So if a market has a severe crash, it is probable, it's likely, it's statistically, what should happen is that it actually goes up in price. And so on the downside scenario, there's a lot of things that are exciting. The other is related to short sells. I talked about how a lot of people are short GameStop specifically. And so GameStop should expect a more significant impact if those shorts are forced to close, compared to if shorts in another company are supposed to close, because of how many people need to close. This is getting so long-winded. If you watch this whole thing, hey, send me a text. Maybe I'll mail you a cookie. But what does that mean, or why is that relevant in a recession? Anytime someone makes a short sale, they're using their portfolio as collateral for their short sale. So a lot of times their portfolio is going to include holdings in the S&P 500, in companies, and they'll have some other shorts as well. But people that short the market, they generally are not putting 80% of their money in shorts. The risk associated with that is impossible. Most brokerages wouldn't even allow that. The most they would allow is maybe 50%. So you can have the other 50% in assets that would appreciate and that you can use as collateral for your shorts. So if that half of your portfolio, the assets, the overall economy, the overall market, if that ends up crashing by 50%, the collateral that you used to create these short sales therefore went down by 50%, which means you need to close 50% of your shorts. But if you close your shorts, what that means is you are obligated legally to go ahead and buy the company that you have shorted, it at whatever price it's being sold at that day. Now if that happens and you multiply that by a higher short percentage than perhaps we have ever seen in any company ever, again, it would not surprise me to see an astronomical return. So the upside's crazy on the short sale perspective, which would probably be triggered in an extreme recession scenario. Simultaneously, the upside is very exciting on just a fundamental transformation perspective, because the company is actually on pace to return to profitability. and it is also and it's the downside risk is also very low because this company's market cap is so small compared to a Tesla, and simultaneously they hold no debt whatsoever other than a, a very small debt associated with the French government's response to COVID-19, but it is like very, very small. Simultaneously, they have like 1.3 billion in cash, and so the company, if it's worth right now $10 billion, you know, like a certain percentage of that company is just cash. That's not even talking about the value of the company. And so on the downside, it can only go so low if it is profitable and it has no debt and it has a ton of cash. And if it's going to be more profitable in the future than it even is now, then that's another indicator. Then you talk about S&P 500 inclusion. If they keep growing in their profits, then at some point they will be admitted into the S&P 500. This happened with Tesla back in the fall of 2019. And if you remember, that's when Tesla went up 1,000% over those next, 16 months or so. Because institutions that track the performance of the S&P 500 are forced to buy in to this company at whatever price it's currently at, so that their ETF mirrors the S&P 500's actual returns. Simultaneously, shorts would be forced to close at whatever price, again, because they're so far underwater on their short position. So a lot of things fundamentally that are really exciting, insider buying. There's also this ethical perspective, which is maybe even more significant than any of it, but I'll have to save it for probably the next video because who knows how long we're going here. I'm already at 42 minutes. Holy smokes, guys. I'm sorry. I'm so sorry. Hey, if you listen to all this, you really are a champ. But I wanted to take the time to explain these because it's a significant part of your strategy, my strategy for your portfolio, and so I wanted you to get to hear a little bit of it, just in case these things do happen in November, and then at least you can know that I gave you a heads up instead of you realizing like, wait a minute, why did this crash or this go up so much or whatever. So GameStop, I'm almost done. What was I talking about? Short sales, fundamental transformation, insider buying. Oh, the ethical side. So another thing I'll touch on with the fundamental piece is that video games are historically very, very recession proof, very recession resistant. It's a very cheap form of entertainment, so people still play them. The ethical side of investing in GameStop for me is not really about video games. I don't play video games myself, and so I can't say that, oh, I'm just so excited to promote video games. But the ethical side is more related to some, like I've mentioned in a couple of videos, some systemic issues that are significant, even illegal, even like very grievous levels of crime, particularly politically and financially, that my research and my tracking of data has led me to perceive. Now, I can't say anything's for sure because innocent until proven guilty, and we'll get there, right? I can't just say that so-and-so did such and such, because until that is proven true, or unless that is proven true, then, I'm going to be sued for libel or something like that. But it's, I'll just, man, I just want to keep going. But the short of it is that most likely, well, we know for sure, if you want to read Naked and Short or Naked, Greedy and Short by Dr. Suzanne Trimbath, that would be a very helpful book to read that explains the impacts of naked short selling on the market. But basically, there's a lot of probably collusion related to not only the artificial suppression of companies, but even the artificial bankrupting of companies in order for high ups to all pad their pockets in significant ways at the expense of everyday workers who all just then lose their jobs. And that's just the start of it. I mean, I really could go for a long, long time, but 2008 exposed some foul play going on upstairs in some big financial rooms, and I expect that our next severe recession, if it happens, will expose even more severe foul play than 2008 did. And you could say people were a little bit upset in 2008. So my best guess is that there are many, many, many documentaries made about what ultimately ends up transpiring with GameStop, and that it will be a company that is taught about in business schools for generations to come. And I would also expect that people that own GameStop will be treated as villains if, the stock market crashes 50% and simultaneously GameStop is up 2,000%. People will make GameStop out to be the bad guys, but then what will come out is that really the bad guys are the bad guys. So it's probably hard to follow. Sorry for giving you like some information, but not everything. I want to end this video because it's getting so ridiculously long. But that's the gist of the GameStop situation, the Tesla situation, and both of them announcing significant things in quarter three. With GameStop, it was their earnings report that basically validated the actual fundamental transformation of the company. That for me was significant, because if we don't have that, then we're just hoping for a short squeeze. We're just hoping that crime gets exposed. We're just hoping that the economy crashes so that we can see how many people are short and just ride this thing for however long it rides. But with a fundamental transformation, now we don't need the economy to crash. This company's supported fundamentally many times over. And I didn't even talk about their tech developments. They're not just reselling hard copy video games. There's a lot that they're doing, but I'll save that again for another video. And last thing maybe I'll say about it is, if you go back to 2021, you look at the price history. You take AMC, for example. They right now are down way farther than they were even before the squeeze happened in January 2021. What does this mean? Like, they were being shorted. Let's take their 2020 price. They were at $50, $40, $30 a share, on their way down $20 a share. And then this squeeze happens that sends them to 80. But now they're down to like $8 a share. What does that mean? The shorts are winning. It's becoming less and less and less valuable. Simultaneously, they're spending money on random things like buying a gold mine somewhere in the middle of nowhere. There's not a fundamental shift in the company. There's not a reason to speculate why in-person theaters are going to grow or be more important to people in the future than it is now. Most likely it will continue to decline. With GameStop, however, they were being shorted. In 2020, their price got all the way down to $2 a share. They were way down, and which now it might reflect as like $10 because they did a stock split. But regardless, they're still on a 5-year basis. They're up 300% even right now, meaning all of those short sales that happened in 19, 20, 21, they are all most likely significantly underwater, still feeling the pain. And they're paying interest on those shorts, which most likely is what led to the Archegos collapse in 2021. And when Archegos their book was taken on by Credit Suisse, that is what collapsed the Credit Suisse, or created the Credit Suisse collapse. One of the largest global banks collapsing because of the book of this small hedge fund. And Credit Suisse, when they testified before the Swiss government on what created their bankruptcy, why did they go under, they cited this meme stock associated with Archegos. This is what they're saying to the government. Basically, there's a company that were paying so much interest on these significantly underwater shorts that it bankrupted our entire company. And you also had a lawyer from Citadel, which is a market maker, also tied back to that meme stock days in 2021. Just this past month was testifying and arguing to the SEC why they shouldn't be enacting the rule changes that they're doing right now, you can tell that I've spent so many thousands of hours researching these two companies that this is actually a very condensed video. You should be very thankful. But they're they're arguing with the SEC, testifying why they shouldn't be doing these rule changes just because of one stock, or one meme stock, I think he said. And so, and then you have the SEC publishing a report a year or two ago on, why did this happen? What related to the GameStop squeeze and back then. And that we don't really care too much about all of that, other than it's not over. It's still being talked about. It's still being debated. Shorts are still underwater, and they've only grown in the level of shorting, and they've just really grown in their ability to hide the shorts, even like tokenized swaps through FTX. And of course, FTX went under, but there's not, stock purchases are not happening to support the value of their tokenized swaps, but they're still letting companies use tokenized swaps as a locate for their short sales. It's getting super complicated. You're not going to track with me at this level probably, but basically that all is still happening. But more importantly GameStop today is not just this crazy thing that happened in 2021, and that crazy thing, as crazy as it may have been, is still yet to come down to earth, probably because there's still so much upside still to go. Like there's an actual transformation happening. Video games, on the other hand, like let me just talk about I keep saying last thing, but I talked about how theaters, AMC, people going into the movies, there's no real bullish narrative for why would that make more money 10 years from now than it makes now. Video games are a whole nother world. There are 1,000 reasons why they will probably make more money 10 years from now than they make now. A lot of it's due to blockchain, which allows people to own assets. And there's a lot, like Immutable as a company, for example. Even GameStop itself has created a wallet and a marketplace. But the short of it is technology is growing, AI is growing, vision is growing. That makes the gaming experience that much more compelling for people. You have streaming now, you have communities, but the in-game assets and the games themselves being owned by people is a significant bullish trend for the gaming industry. So now if I have this character that I develop, instead of just selling my account and give someone my password and then let them change the password, now I can sell you this axe that my character has that I got, and boom, I can sell it to you, and now it's in your little inventory box, and now you own the axe. And I'm going to make money from that because I actually own the axe, because I actually own this video game, rather than I bought a copy of this hard drive, but the video game itself and all the characters are 100% owned by the creator of the game. Now every player can own their own assets and sell assets player to player. So that technology is already it's happening, and the application of that is growing significantly and will grow significantly in these next gen technology games, especially. So even skins, different things. It's not all going to go to Xbox anymore. It's going to go to players. And what does that matter for GameStop? It matters because they own a marketplace by which those transactions can occur. So they're going to get a cut of every single sale of that. But again, hopium wise, you don't need that to happen for the floor to be high, because the fundamental level is happening even before any of that next gen transformations happening. But I wanted to zoom out a little bit just to talk about, why would video games even matter? Now, 10 years from now, we might not even own it, because ethically, as it relates to video games, I'm not super morally opposed, but I'm not like just so inspired by them. But the ethical narrative of GameStop right now is more so related to corruption getting exposed that I think will come to a head in this particular company. And the financial perspective is protection, and not only protection, but significant outperformance potential in a severe recession. Overall, my perspective is that we are getting closer to either a severe recession or a technological breakout. And either way, I think our portfolio is going to do great. So sorry for how long-winded I got diving into those two specific companies, but I wanted to because they are significant concentrations. They're companies that I know back and forth, thousands and thousands of hours in both of them. I've spent researching and learning in both of them for 3+ years. So, it's hard to compare the level of conviction I have for these companies versus another company that, maybe there's a total of 5 hours of research that I've done for them, but enough to make me feel comfortable with them being in your portfolio, but never ever would I put them at such a high concentration. Because for me to do that, the risk that I would feel would be extreme if I don't have enough data and knowledge to support that type of concentration. With these names, I would not lose sleep if 100% of your portfolio was in either of these names. Now, you would lose sleep, which is why I didn't do that, but because of the overall economy progress that we saw in Q3, because of the company specific progress that we saw in Q3 in these two names, I feel like both of these specific companies are getting a lot closer to their next level breakout that will be significant for them, almost regardless of what happens in the economy. But I also feel like the economy is getting closer to its either breakout or breakdown, which will then almost domino effect into the stock price of one or both of these companies. And if it's one and not the other, or one before the other, I still think your portfolio is going to hit a significant payday, because it's not like that would create an incredible downside scenario for the other just if one went up significantly. So, and hopefully I touched on that, how even in a recessionary environment, Tesla can still do great. And even in a bullish environment, GameStop can still do great. But their breakout into, otherworldly or, meme level stock price activity, probably more likely in Tesla. It's if we have a technological breakout, probably more likely in GameStop is if we have a severe recession. We'll see what happens, guys. Again, Q4, I don't think it's going to be that eventful. I think it'll be, I guess I could say I'm a little hopeful, but I wouldn't expect it. I think it'll be kind of normal, maybe a little bit up, maybe a little bit down, kind of sideways trading. And I think in hopefully the first 6 months of next year, we kind of see which of these narratives is looking more likely. So I'll keep you all posted, of course. Personally, I'm very, very, very excited. Hopefully you're excited too. Q3, we gave back some of the melt up, let some of the air blow out of some overinflated names, a little bit overheated in the short term. We're not in a bona fide bull market right now, but there's some things that could get us there. We're not in a FOMO crazy level recession right now, but there are some things that could get us there. We'll see what happens. If you appreciated this level of depth, hey, let me know in an email, because I'm here still recording this video. Or if, hey, there's something you want to follow up on, something I said that, hey, can you explain that again? Or, again, totally reach out to me. Super happy. If there's anything that you see incredibly differently, I would love to have in-person conversation. Let's jump on a Zoom call, because I think obviously my conviction is really high here, and I think you'll be thanking me for years and years to come related to how I'm managing your portfolio right now. But we'll see. I don't want to get too ahead of myself. One day at a time, right? One quarter at a time. Thank y'all for trusting me as your financial advisor, and I'll talk to y'all soon.